Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, November 26, 2024. It's 11:03 a.m. Eastern Time as I'm starting the video, and here's what we're going to do in this one, and I'll try to keep them in this order. I'll do a quick update on the equity markets, and that's going to sort of segue into the semiconductor sector. To me, the stock market's really the Nasdaq 100. It's most tradable. It's not the most representative index, but it's certainly the most tradable, and it does determine where everything else goes due to the high tech weighting. About 50% tech stocks in the Nasdaq 100, and the S&P 500, although it's more diversified, it has financials and things that the Nasdaq 100 is lacking. The S&P 500 does have the technology sector as the largest by far, at about a 25% weighting. So again, and this is just more of a concentrated look at the leaders that drive the S&P, drive the whole stock market up. That's what you're seeing here, just a higher weighting in those big Mag 7, Mag 8, whatever you want to call them stocks. So we'll look at that. That'll segue into the semiconductor sector, very closely related sector. I always say the semis are really the canary in the coal mine, if you will, for the tech sector. And so we'll do an update there, including just a couple, not a deep dive, but just look at SOXX, NVDA, Tesla, and an update on SMCI as a short trade idea yesterday in the video. And then I want to do the rest of the video. Oh, sorry, Bitcoin, quick update on Bitcoin. Still like that one. And then the restaurant stocks. So the restaurant stocks, I think, are really nice, setting up for a nice move. I've been highlighting those on and off over the last year. We've had some swing trades in and out, but I'll get to those at the end here. So let's start out with the Nasdaq 100, which you're looking at here. Very simple, clean chart, and just keep it even more simple. This is a trend line right now that I'm watching. It's the one off the August 5th lows right there. This major reaction low. We had one like this. Then the elections came, and a lot of things. We had a earnings season with all the big tech, all the Mag 7 stocks reporting around this time, Fed meeting and all that. So you had a couple of whipsaws through that initial trend line, like I had drawn like that. And if you go that route, we're still below it. We broke down. We had a post-election Trump pump pop there, and then we're back below it. So you can do it that way, but this is the one I'm watching now. This is what I call the benefit of the doubt line. Comes again off the August 5th lows, nice clean reactions, and I think that's the one that'll do the trick when you look at a different board. We're still in, this is, here, let me go to my weekly. That's where I gave it to you initially. I'll zoom in, it gets busy, but it'll zoom in nice and tight. And this is still, the Nasdaq 100 still in that market top range that I laid out all the way back in late June. No resolution. I mean, we had that first leg down, then we covered expected a bounce. We're back to the top. So again, nothing happens in my book until we break this trend line. If we have a solid breakout, it's going to take a while. If it starts to go up to the point where the divergences are taken out, then the technical posture changes. So, we don't have to reverse here. It's still where I, think the market's likely to peak. But again, it's to me, it's super simple. Nothing happens until that trend line goes. I just jogged down to a 60-minute chart here for you. There, you can see it there. You can look at it on any time frame you want, daily 60-minute chart, and that's it. So we have divergences. You can see even on the 60-minute chart, I really like to see. We don't always get it, but quite often the inflection points come when you have divergence on the 60-minute time frame. I'm talking swing trend changes. The nice move. So if we could punch up just a little bit higher here, make a marginal new high, then reverse break the trend line, even better. And again, that doesn't have to happen, but you can see if it happens, it's going to have to happen soon. Why is that? Because the way I drew it here, if we go up much more than just a marginal new high and then reverse, then you go up and you're going to bring these indicators up and you won't have that 60-minute divergence. So again, we have divergence right now. This was, let's see how I had it drawn. This was a divergent high here on the 60. We could have divergence on the daily chart. Very, very clear negative divergence. I know some of these are what I call messy boards. I started with a clean board. There it is. There's your divergence right there. Just like we had divergence there before that 17% drop we milked from high to low. We had the divergent high there. So these are all the biggest corrections in this bull trend that we've had off the it was technically the October lows. We did a double bottom there, and that was strong positive divergence. You remember I was very bullish, overweighting the Mag 7 tech stocks then, highlighting Amazon and Apple as my two top picks, but also liking the whole Nasdaq 100 because that was a very, very nice setup there on the 60-minute and daily chart. And that was a catalyst, the technical catalyst for this whole trend. So, all right, guys, watch that trend line. I don't beating a dead horse here, just saying the same thing. I think that'll do it. But not just that, by the way, not just that. And that's why I do these videos. Remember, or well, if you're new to the site, to me, this is the all-important stock, NVIDIA, and I have it on different boards, but you can see it's the same trend line. I've been harping on this trend line for quite a while, even when we covered back here when it was hit the 200s bounce. We did it again. NVIDIA has been walking up that trend line, so I had it as a valid trend line way back then, and we've had multiple reactions since. Now, my point is that further validates the trend line. The more reactions you have, the more eyes are going to see it, the more important it is. That's my logic and on how technical analysis works. If it's some obscure chart pattern or iffy, sketchy trend line that you're trying to draw, which the security has gone through, you have a lot of violations of it. Well, it's not to say it can't work, but you're not going to have as many eyes picking up on it and watching it and trading it. So this to me is and look, they come in together. If QQQ breaks that trend line, NVIDIA will most likely break it shortly after. So bottom line, if you want the odds to go up tremendously that my long-term targets are going to be hit, again, whether we punch a little marginal new high, and remember, I'm not going to be here next week. I'll be on vacation. I'll do my best to post updates when I can. But it's going to be, some vacations are every night back in the hotel room. This one, we're going to be on a boat in the middle of the Caribbean. I don't know what the Wi-Fi service is like or the cell service there, nor do I really plan to spend a lot of time on my phone or computer, to be honest with you. So I want to get these levels out in advance so you can replicate them. If you're going to do that, make sure you use log scaling. You're getting a completely different picture if you don't use log scaling. Here, I'll show you what I'm talking about. You click here, log, go to arithmetic scaling. You can't draw a trend line on a stock that's gone up like NVIDIA or the stock market. Log scaling, what it does is it calculates everything in percentage moves, not dollar terms, because there's a big difference when a stock goes from $10 to 11. That's a 10% increase, but on a 1-point move, when you're a $100 stock, a 1-point gain is only 1% increase. So it's a factor of 10 there, and that's what log scaling does. It's logarithmic, semi-log scaling. So that's it. Can't really say much more about that other than I have a high degree of confidence that this trend line will go despite, and I'll just sidebar it now. Since I've got your attention, I'm not going to do many more videos after this week, maybe a couple more between now and tomorrow. My God, the bullishness on TV and in the media. I read news feeds, articles, turn on the TV. All I'm seeing is price targets on the S&P going up. Crypto, my God, you think it's going to go to the moon, and all these are counter. You can look at sentiment surveys, AAII, things like that, extremes. But you can, a real-time sentiment survey, just click on the TV and listen to, or read the headlines, one brokerage firm after another, the big Wall Street firms, raising price targets. One of them recently threw in the towel, capitulated on their somewhat bearish outlook. I forget which one that was, one of the big banks. So it's all there, guys. It's all there. But listen to me. Nothing, and I mean nothing happens until you break support. So that's it. Can we break this trend line on NVIDIA and QQQ and then just go down a little and go up? That's possible. And if it does, recognize that. Because as I often say, fewer things in trading or investing or technical analysis are more bearish than a failed breakout. So if you were to see NVIDIA go down, let's just say it goes down, hits the 200s again, then they rally up and they take back the trend line, and QQQ does the same, yeah, then you might see something else going on. But these are what I'm going to call in advance high probability sell signals that I'm waiting for. They appear to be likely and imminent. Imminent is relative to the time frame. When you look at a chart, a trend that started back in October of 2022, so it's over a 2+ year trend, or 2-year trend. Imminent doesn't mean today or in the next hour or even next week. It means, in the coming, most likely in the coming days, weeks, or months, somewhere in between there. And again, I can't tell you the when, but I can tell you as far as the day, but I can tell you the price level. So watch that level, big level, got about 130 price support as well. If that happens, you want to see QQQ breakdown as well, and you want to see some of the big market leaders roll over, and I have a pretty high degree of confidence that will happen, despite the somewhat resiliency of the market lately. Okay, enough on that. Tesla, I'll just update that because I threw it out today as a new trade idea. And, it was all in the chart, but yesterday we had a bearish engulfing candle. I said you can use a tight stop, no more tight stop. I'm going to give you, people have asked lately, can you give recommended stops? Well, it depends on what you're going for. Like, for example, SMCI yesterday, I threw that out as a pullback trade. You could close it out today and you booked a 10% gain in one day, or you can hold out for a bigger drop if you want. I'll get to that one in a second. Tesla, when you see a bearish engulfing candle, if that's your reason for shorting it, I love those setups because they're very the RR is phenomenal, and the risk reward ratio, because number one, that is only look for a bearish engulfing after an extended uptrend. Don't look for it after stocks bottomed and the first leg up. That's not a trend reversal. They are bearish engulfing candles or topping sticks, just like bullish engulfing candles. That's what we had when the stock market bottomed in October of 2022. You had a big bullish engulfing candle I highlighted there. Those are major trend reversals. Here, I'll show it to you. SPY or QQQ, you can look at either one. And you go back here, turn off all the lines, and that was it right there. That big, giant green candle. I know it's hard to see in the video unless you pull in tight. And so what they do is they mark an inflection point, a trend reversal that ended the bear market in 2022 in the S&P 500 and technically in Nasdaq. Nasdaq almost double tested it in January, but S&P didn't, just kept going up. And that's what we have there. So it's like any trade. It either works or doesn't. My trading style is, if you follow me for a while, is highly contrarian. I want to, buy when no one else wants to buy. Typically, I try to call tops and bottoms. Sometimes you get cut when you're trying to catch a falling knife, but when you do, that's most of the gains are after the initial reversal. And then what I call trend chasers, they call themselves trend followers or trend traders. They say try to align with a trend. In certain markets, they get chopped to pieces. And in the big moves, they don't realize, by the time you can say a trend is over, the next new bull or bear trend is halfway done by the time they recognize that and stop buying dips or shorting rips. So anywho, I like to get in front of those quite often, and that's what we're looking at here. So there's NVIDIA. I need to pull that line down a little bit, guys. As I'm doing this video, I see as I was zoomed in, I have different boards. There it is. You want to come in, capture that August 5th low, capture that reaction low right there from September 9th. And so we're a little bit above it. I just needed to adjust it sometimes. I have different boards. It was correctly set on this board right here. That's the first one I start with. So back to the Tesla, right? This board here. So that's it. So a tight stop can be set right above the top of the bearish engulfing, because if you go any higher than it, then it's not a reversal stick. Doesn't mean you can't punch through and then go down. It just means, by definition, it's not a topping stick. And so then your risk reward is tremendous, because you're risking, depending if and when you shorted it, you're talking about a 7% stop loss. These are targets I will most likely add to, by the way. So my final target's about a 42% drop on Tesla. As I mentioned, and you could see in the post I gave you today, we have a pending, what looks very likely. You don't have to be an expert technician, market technician, to see, where, once the PPO stalls out, especially at high level, and starts to roll over, sometimes they bounce, but usually you're going to get that crossover. So it hasn't happened yet. But when you do, as I showed you in the post I got out to you this morning, I'll change that tool to an ellipse. It's pretty simple, guys. It really is. Just look for these high-level bearish PPO crossovers and look what happened to the stock afterwards. And, you know, you're reading the headlines lately. They had that bromance going on between Trump and Musk. And I said this before the media was talking about it, like, okay, there's going to be a big conflict of interest there because Trump is anti-EV, already talking about rolling back the 7,500 EV credit. And now you have California coming out saying, well, if they do that, if the federal government takes the EV credit away, the federal credit we'll initiate state credits, but we're probably not going to give it to Tesla because that we need to even the playing field. So we'll give it to those EV makers sucking wind. So, and you know, the media is all over Tesla right now for you know, the factories, you know, polluting the environment and all that. It's whatever. That's fundamental ramblings, guys. I go off the technicals. I just wanted to say that this, I think that Trump pump was overdone. And so, you know, if you think so too, but you don't think we're going to go that far or much lower, then just go for a short, go for the first targets if you like the trade, and then you're going to use a tighter stop. But if you are going to these longer term targets or more, which I might add, you might want to give yourself a little wider stop. On that, and I almost put it in the post this morning. I didn't want to get too wordy. I just wanted to get out to you. It should go without saying, but I'm going to say it. The odds of Tesla playing out, especially these deeper targets, you know, 40+% drop, is highly, not 100%, but very largely contingent on NVDA and QQQ breaking down and then starting to go down to those next targets I gave you there. If that happens, it's a whole birds of a feather thing. These, you know, big tech stocks tend to move together. Okay, I got a lot to cover. Let me move on. Take it, don't take it, up to you. The video I already covered. I'll do an update on SMCI. Again, one that, you know, you decide whether to take, not take. Highlighted yesterday at T2, with that former bounce target from the previous trade. And you're good. Now it's ticked back up a little bit, but, you know, one day 10% gain, take the money and run, or set a stop if you think it's going to go down more. I don't have strong convictions, but there was a little gap fill. So basically T4, remember on the previous trade, that was also, I give you 60-minute and daily targets. The daily target, the final target was T2, which was hit yesterday. And then T4 was also hit on the 60-minute chart yesterday. And so that was good resistance. That's why I had it there as the final target on that previous trade. And then you can see now we have this uptrend line, which just cracked. And so again, they're going to get, you know, backfill the gap. That's a minimum target. You can set a stop. You can lower at this point. If you made 10% a day, if you took it yesterday, you know, from that video, why not just at the very least lower stops to protect gains, to protect profits, or just take the money and run and get out of that. I don't have a strong opinion. Personally, that's me. I covered it today. That's it. 10% good one time. And you know, if it gets to another level that I see, for example, I could see if it happens to push up here, there's a big old gap. If it can power up there to be backfilled, massive resistance right here. That would be the next area I'd be interested in making a trade. On the long side, I don't know. Like I said, the trend indicators I told you yesterday is bearish below the zero line, and you got to be careful with that one. So let's see what is next. Let's just roll into what I wanted to cover here. Well, the rest of the video we'll do. Oh no, I told you Bitcoin, didn't I? Yes, I did. IBIT is the ETF. I also, in that setup I gave you the other day, I believe I mentioned there is a short Bitcoin ETF that you can use. I think it's BITI. I'll check in a second. Just a, you know, clean little trade, nice setup. We're still only halfway to the first target. Since the breakdown, it's down dropped about 7.5%. T1's right there. So at this point, you know, you can set a stop at entry to just sure at least a break even on the trade, or keep a stop a little higher if you could certainly might want to make a punch at another high. But either way, looks good. And, you know, those are still the targets. I think I gave you arrows. If I didn't, I'll tell you right now. T2 is my current preferred target. We'll probably most likely get a bounce there. There's a big old thin zone right here. See the volume price histogram bars, these red and green bars. And then there's a gap right there. So you have a thin zone. and traders will usually buy a gap, so you could something like that, and then ultimately once we take out T2, whether we bounce or not, then the gap once entered usually gets backfilled. That's T3. You can see that's where the volume bars pick up again, the volume price histogram bars. And so we'll kind of, I wish I was going to be around, and that's why I do these videos, kind of tell you what to watch, how to trade, because I might not be there to update each of the this trade as it progresses, if it continues to progress. There's some minor support right here. I should have given you that right there. That would be S1 is what I would have named it if I would have put it there before. Why? Because I just showed you a reaction high there, another reaction high, and then we kind of danced on it. And now you've established this reaction low today, so that now becomes the level because you overshot that S1 level by a bit. So we need to break that to open the door to T1. And then the, like I told you, sister trade. And there's a lot others out there. And before I leave town, I may add some more. We'll see. I don't want to, on this one, we'll see if it starts to gain some traction. But there's a lot of what I call the crypto proxies. And one of those, of course, is the micro strategies that I got out. And again, to take this trade as just a duplicate of the Bitcoin trading. Probably, in my opinion, it will fall more than Bitcoin. And I really like it. I mean, it's got that everything I like to see in a chart. Big, fat negative divergence, which is about to be confirmed today with a high-level bearish PPO crossover. This is a high-level bearish PPO crossover there. The stock had just a little more upside, and it did fall. Don't get me wrong. It fell, 50%. Okay, so it doesn't look like a lot here, but that's a 50% drop following that divergent high, and you had the beautiful bearish rising wedge break and the drop there. And it also went sideways for a long time, quite a few, about 6 months or so. And you can see that top of that trading range is T3. This is a bearish engulfing candle. Big, fat negative divergence. Again, look at another pending bearish PPO crossover. Volume is highly indicative of a buying climax, which also, what it sounds like, it marks a top, a trend reversal. So there's a lot of evidence here early, but potential evidence of a top, as well as Bitcoin, which I'll get to in a second. And so you have the targets. Trend line is the first target, and then T2, T3, T4. And that would be, we broke down yesterday. So T3, which is what I call my current preferred target, that's going to be a 56% drop if hit. Actually, a little better, 57%. And again, expect a reaction of T2, and the trend line might come in together. It's first reaction there. But we could go right down through it. This is a hot trade. Bitcoin's a hot trade. And when hot trades break, overloved, overowned, overcrowded trades, quite often you just blast right on through the first support levels like they're not even there. So kind of what I'm getting at is when I leave town, if I'm going to be, which I probably won't be in front of my computer, I'll have my OCOs I'm not going to cover there. If I was at my desk at the time and I could analyze the charts, the intraday charts on Bitcoin and MSTR, I might, cover and game a bounce like I often do. I call that micromanaging a trade, a swing trade. Game the bounces. But in this case, if I leave town, my OCO, I'll have a stop and then a final cover down there at T3 in case that happens to be hit. Alrighty. And remember, crypto itself. This is Bitcoin. This is the crypto, trades on the Paxos exchange. The actual BTC, Bitcoin crypto. There it is. Big. Just like MicroStrategies, big negative divergence. You're looking at here. This is a 2-year chart with daily candles, so 2 years of price history. And you can see down here, that was a high-level bearish PPO crossover. If I can click on my circle tool right here. And that was followed by that big drop there. Measured out, but I showed you it was 50% in the MicroStrategies. And then now we have both negative divergence. We have the indicators making lower highs versus prices making higher highs. And we have a pending, it hasn't happened yet, It'd be nice to see it before I leave town, before the holidays, but you can see the PPO is clearly curled down and is poised to make a crossover. Again, sometimes they bounce and don't cross, but usually you get that high once the momentum turns, because it's a hot trade. It's a momentum trade. Now people start taking profits, start being hit. But again, so a little more downside will give us that bearish PPO crossover, and then what I call confirm the negative divergence. I like it to see that bearish crossover to effectively put in a lower high to what I call confirm what is now just potential negative divergence. Okay, and then you can see my targets. They were already shared for you if you're trading crypto. I think I gave you on Bitcoin futures, or you can trade this. There's that pullback. This trend line is going to be visited sooner than later. And you can see nice price resistance here. And I'm just going to try to measure it for you. We got the sell signal yesterday. Be about, on Bitcoin should drop about 25 to, depending, the trend line will probably come in there, about a 25% drop, maybe 30%, depending on how long it takes to get there, if it plays out. Okay, the rest of the video will go over, not all, I've got about the top 30 I want to cover, and here's what I'm going to do. I'm going to show you EATZ. That's restaurant ETF. It's the only one I know of. To the best of my knowledge, there is not an inverse or short ETF to solely short the restaurant stocks. If you know of one, please post it in the comment section if you're even interested. And that's what I'm going to do in the rest of the video. I'm going to go through the restaurant stocks. I'm going to, well, let me start out here with this real quick. If you want to use this ETF, it's a little thinly traded, somewhat thinly traded, so you might want to use limit orders, buying and selling it. There's a trend line which really technically would be your first target. There's no sell signal on this one now, but I'm going to go over the charts, make the case. I have been making the case. We had a divergent high here. We pushed up, made a marginal new, and still divergent high. So I've added this target here, T1 there, about 27.50, T2 at about 25.90, T3 at about 24.77, T4 right around $24. That should be T5 there, about $23, and then this would be T6, maybe. T5 right now. Well, I can tell you my current preferred target, T3. I really like that. We'll probably get a reaction there. You had this sideways trading range there. Consolidation, a breakout, a successful backtest to help validate that. That's again at 24.77. And you have the 200-day moving averages, which, remember, August 5th. That's where we closed all shorts, went long, hard long. Everything, just about everything hit the 200-day moving averages or key trend lines, including this. So we've come full circle off that bounce. And now I'm going to roll into the individual names. I just need to queue up one. And now what it does is it gives me a, instead of just the components of EATZ, which if you want to, you can look at it here or go to their website. You can see these are the ones in EATZ. But when I key in any one stock, it gives me all the restaurants here. And that's what I'm going to go through in the top, just the top 30. I'll go through relatively quickly. This one I shared as an official trade idea for you in one of the videos back there. Broke down right away. We had that bearish rising wedge. By the way, guys, if I don't mention it, just look. You'll see on most cases you had negative divergence on a lot of these stocks put in recently. We did the same thing to McDonald's back here. That stop was never hit. We went down, swung it down, hit the first two targets there, and the only targets. I had a potential T3, but never made it final. Then we had a bullish falling wedge here. Remember, everything was bullish back in August, coming to those lows, breakout. We've come full circle. This is wash, rinse, repeat. Get these divergent highs short. There's a divergent high short. There's a divergent low long. And you don't just go long on divergence, just like you don't go long on oversold or short on overbought. You like to see the divergences. They confirm a trend change is likely. Then you wait for a buy or sell signal. In this case, this is a bearish rising wedge. You get a sell signal. McDonald's, they came in and bought it right on the 200-day moving average right there, the 200 exponential. See these red and blue lines? Exponential, simple. They rejected there. So it isn't an uptrend. They need to go. I think they will go. I'm not going to spend time on the weekly charts on a lot of these guys, but I can tell you they confirm, just like the stock market, you keep getting these divergences. You keep getting big tradable, very profitable. Remember, this is swing trading. This is investing right here. This is swing trading, long, short, long, short, long, short. And then this says longer term, these divergences, it's really one big divergence that continues to build on this weekly chart. And when it plays out, it's going to play out for a big drop. And I see McDonald's, and it's commensurate with the bear market I see coming in equities overall, down to these deeper targets. I'm sure McDonald's will get kind of a high degree of confidence, probably lose 50% of its value, at least, at minimum, about 35%. But where does it all begin? It begins on these shorter term charts. So this one, all I can tell you right now is a pushback. There's big resistance here. Any pushback to that level would be an objective short entry or re-entry. That's the first leg down right there. Counter trend bounce, and we'll continue on down to these deeper targets. Not my favorite right now. A lot of the meat already has been sheared off that bone. It dropped 10% off that initial drop, but I think it still goes lower. Starbucks, this one is a setup. You see a nice clean up trend line. Again, wash, rinse, repeat. Divergent high correction, divergent high, bigger correction. That's two consecutive divergent highs. Divergent high, correction, divergent low, rally. And now you've got nice, clean negative divergence with an uptrend line in which to trigger a sell signal. To sharpen my pencil, but yeah, I'll leave that target there, about 80. It's about $90 initial target. And then down here, somewhere into this area, about 82.77. CMG, Chipotle, divergent high correction. That's when we swung them down the previous time there. And you have this primary uptrend line. So far you have a stock, like most stocks, that have been in an uptrend since, mid to late 2022, right? And you get these divergent highs. This was one right here. You get these, they swing it down, then you look for a bullish falling wedge. We didn't have the uptrend line at that point, but that started it, that created it. So you had a reaction there. Now you had a reaction there, and recently we had another reaction. That's a third and confirming reaction. So that's an important trend line for me, and one that I think will be broken. This was a lot of evidence of a top. There's a bearish engulfing candle there. You can see right there. You only have to engulf the body. The fat part has to engulf the body of the previous one, not the shadow, not the skinny part. And so that was a big fat bearish engulfing candle. Wiped out 1, 2, 3, 4, almost that fourth of 3 previous candles. And Chipotle fell by 30%. And you also had a breakdown and a back test and a rejection right there. Tried to regain it. All right, so this is where we're at now, guys. Uptrend line, divergence line, sell signal to come. You've got the 200-day moving averages, 2 that'll give way there. And then when that trend line goes, that's going to open the door to a much bigger drop. These would be my longer-term swing targets down here, and that's calling for a drop of up to 42, 43% in CMG, Chipotle. There's the divergence. It just needs to be extended. Yum, they own KFC, Pizza Hut, Taco Hell, Habit Burger Grill. This one, you can see like a lot of them looks very toppy. You can see this is where the stock has been topping for years now, last several years. Major resistance. No sell signals at this time, but if you replicate this trend line right here, it comes off the October 2023 lows. That would be your sell signal. Any new high anytime soon will simply be a divergent high, so not a breakout. Because bulls, what happens is, a bullish trader or somebody who's bullish on the stock is going to see that and say, oh yeah, this one looks like wants to really break above that 143 and run. And it'll run briefly. What you'll see is a stop pop. Shorts will squeeze out. New longs will buy them, break out to new highs. And it's going to have big negative divergences and overbought conditions if it happens anytime soon. And as I've often said and highlighted all but a gazillion times over the year, breakouts that occur with negative divergence and overbought conditions have a very high rate of failure, and that would most likely be the case. So we don't have to get there. Resistance is resistance unless taken out. But if we did that, you could maybe you don't short the breakout, you wait for the failure to short, or you wait for a break of that trend line, and means take a starter and then add when that trend line goes. And these are looking for major tops, so you could set it and kind of double digit. I'll follow up when I get back if the sector is broken down. What I mean is, if I'm going through 30 of these restaurant stocks right now, And if the majority have broken down, then it's safe to say, birds of a feather flock together, that sector has broken down as well. QSR, they own Tim Hortons, Burger King, Popeyes, and Firehouse Subs. Although I thought I read Firehouse. I haven't updated this in a while. That's 2023. I think private equity just bought Firehouse recently. I could be wrong. Maybe the whole chain. I don't know. Either way, big, this is a toppy stock. This is top back here. It's been moving lower. You've got support here. You had a trend line that was traded through a little bit, so I'm not putting too much of a weighting on that uptrend line, but break below these lows will open the door for a move down to that next target I have there, about 61.73. DRI, I like this one. Potential triple top here. You can see this stock keeps coming up to about this level. And it's been really going nowhere for years. Investors just going sideways in this stock. But swing traders can have a field day with it. And we shorted it back here. You can see these were all official targets. We hit my first. There was our short entry on this. Remember, divergence is not a sell signal. But what is that break of the wedge. When we went down, we hit my first target. Hit my second target. Consolidate around it. Hit my third target. Consolidate on it. And then hit my fourth target. That was it. And then after that, the stock went a little lower, reverse, went up, had a divergent high, and I believe I highlighted back here again. There's a sell signal. It's wash, rinse, repeat. That's another drop. Both times it hits these divergent highs and then breaks the trend line. It drops about 20%. So, you 20% or any part of it, 20% again. And this time around, when you get these triple top patterns, the way you trade them is you look at the bottom of the range. So if this plays out as a true triple top, and again, I encourage you to Google search these patterns, but you look at the bottom, and then the measured target is the distance of the pattern from high to low. So I'm going to draw it here. I'll draw it with this trend line. Here's how I do it. Oh, I have to do this for you. Let me box it in here, box tool. Okay, and we'll say that's the top of the pattern. We'll just call it about right there. And then I take a trend line from high to low, measure the distance of the pattern there, and then add that to where it breaks down. I have to zoom out and look at that. It takes me right to that 104.21 target I already had. And that would be the sell signal. Now, conventional trader is going to wait to see the triple top pattern break on the downside. I like to get in high at the top, get the divergence. The breakdown appears imminent to me, so maybe a starter position, and then add on the trend line break right there, the wedge break. And by that point, we'll probably have one last hurrah off the bottom. You can game that bounce if the charts indicate it's likely, and then re-add on a break of the pattern, and then swing it down to 104 and change. And that's going to give you, even if you don't actively trade it, cover and gain some of the bounces, you're talking about a 40+% gain right there on DRI. YUMC, that's Yum China, divergent high, rejection on the downtrend line right here. So far, there's your downtrend line. That was a divergent high there. You fell. We put in a big divergent low, bullish falling wedge, breakout, rallied up, came full circle. So, this is in a larger bear market. Very easy to see. Simply defined a downtrend as lower highs and lower lows, right? And what do you do in a bear market or bear trend? You short rallies into resistance, like a downtrend line and price resistance, and then boom. So if you did that, so far you've made 10, 11%. And your next objective short entry or add-on to a position would be a break under $43. Then it'll go on, want to fill that gap, then another gap there. And the bear market most likely resumes. This bull market ended with a big divergent high and a beautiful, might not have been watching it back then, but there was your sell signal. All right. Kava, big divergent high right here. Needs to break this trend line. Looks like a broadening wedge pattern, megaphone pattern, but break of that trend line, you can see the targets. 110, 97.20, 71, 71.44. And then down to 58.56. That would be a drop if that final target's hit of about 58%. DPZ, Domino Pizza, looks better than most, coming off this divergent low right here, positive divergence, but it's rallied into resistance, and that's coming off that big divergent high. So it is an objective short. The divergence played out in a bear market or a bear trend. Divergences either don't play out at all, or they play out for a relatively minor bounce, and so that's what I'd be looking at. It is an objective short. That's a big, massive gap right here. Traders love these gaps. Once in there, they're going to get backfilled. The top of the gap right there is resistance. You had not just the gap, you had another reaction there and another one there. Yeah, it's a very nice level, very objective to short with a stop somewhat above, somewhat relative to your price targets. If you're targeting this next, drop it down to about, what is that level? 349, about 350. And then you're targeting a drop of about 25%. So you could give yourself easily a 6-7% stop loss, maybe a back test of this trend line, a little bit above that, and you have a very nice RR. Texas Roadhouse, nice old divergent high, clean up trend line, set a price alert, simple stuff. Set alert, I think I already have one, but boom, that alert goes off. That's your sell signal. Get in, short it. You're going to go down here. It's going to drop 15% from where it is now, roughly. Bounce off initial reaction. Probably the buyers will step in there, bounce it off 173.63 if you want to try to game a bounce. So again, see what the rest of the stocks are doing before you make that decision. And then once it goes down, you take out the 200-day moving averages. You go to the bottom of the range here. This is a second target zone. Below that, it's lights out. And then you got a big old gap right here. Well, once that gap is filled, then we'll go down here. This is a thin zone here on the price histogram. So this is my longer term target. So yeah, these are the reaction points. But if you're keeping your eye on the prize, and by this point, recession will be all over the headlines. The whole soft landing, Trump's going to rally the economy thing, that'll all be thrown to the wayside by this point. And the restaurants will be dropping because the U.S. will be probably in an acknowledged recession at that point in time. And so you're talking a drop of about, if you're willing to ride it out, 42%. Wingstop, big old, that's divergent high, just like that was there. And it's not that it didn't play out. It played out for nice correction, but to really nice support. And look at this, what happened the other day. See these red and blue lines, the 200-day moving averages in a bull trend. They buy the 200s, they buy the 200s, they buy the 200s, they buy the 200s, and oops, 200s gave way. What do you do once the 200s give way? You have a trend change, and then you short rallies into the 200s. So you just had that. We're just right above them right now, or just below, I'm sorry. You have the red is the exponential, and the blue is a simple. So any rallies back up to that, but not above the blue, you can make a case to objectively add on. We're close enough now. And more importantly, really nice price support. Former support. Support once broken becomes resistance. So I very much like this one here right now. Next target all the way down to 210. So that would be a drop just to my first target of about 38%. That one's looks strong. I wouldn't touch this one. That's Dutch Brothers, BROS. EAT, Brinker International. I own Chili's. A couple other restaurants there. You've got a nice wedge pattern. Here's your clean up trend line. There's sell signal to come on a break of that trend line. Again, I think I have alerts, but I'll just set them again. And then secondary trend line. So this one plays out like this. Sell signal to come on a break of that. Reaction there. Come on down to this next trend line here. Even more significant trend line and price support. That's a high probability level to bounce. You'll have the 200 days there. So this one you short now. If you can, want to maybe ride out that first reaction off that trend line. If you're just a typical swing trader, you're going to get about a 40% gain on that short from where we're at now. Again, no sell signal yet, but wait for it. And then turn around and game the bounce long off that level. And you probably make easily double digits. 10% plus, turn around, make, then you're up 50% on the stock. And then at the time, we'll have some reactions in here. I'll figure out where to reshort and then swing it down to the next target or targets and maybe milk 100% return out of that trade. SHAK, Shake Shack, uptrend line right there. big negative divergence, much bigger than this divergent high, which gave us that drop, which was, let me measure it for you, that previous drop, which I highlighted back at the time, was 30%. This is just the divergence has grown much larger, and therefore I expect much bigger than a 30% drop. In fact, I think ultimately this trend line goes. So it works like this. Sell signal 1, you've got some price support there. Once that goes, you get the 200s, and you have this uptrend line and price support. So we drop down to about 93, we bounce, recycle back in short again after gaming the bounce long. Again, if you are like to actively swing trade like I do, and then we'll swing it down to this next target here, my current preferred target. Really nice support here, about 81. There's all these reactions that I'm pointing to right here, and that's going to be, even if you just wanted to short it, throw away the key that we got there, that's about a 37% drop. SG, sweet green, big divergence. It broke down the trend line recently, but it had price support. You can see right here at 32.90. Bounced off that, but put in a new marginal and still very much divergent high. Next sell signal comes on a break below 32.90. That'll take you down to 27.37, then 23.47, and then all the way down before all said and done, down here closer to that. I'm going to raise that a little bit, about $16 final swing target, and might extend that here to this. Oh, it'll come in together. There's your uptrend line. So yeah, this one has about 60% downside to that final target. WEN, Wendy's, it's not labeled, but it's marked. That's a divergent high right there, negative divergence. Watch, rinse, repeat, guys. Divergent low, rally. Divergent high, correction. Divergent low, rally. Divergent high, correction. We'll go back as far as we want. But bigger picture. Let's not forget the big picture. A lot of these stocks are in a bear market. Not everything. The problem is Wendy's and Starbucks and all these companies are having a hard time selling how AI is going to change them. I'm sure at least some of these are trying to throw it out in their quarterly earnings reports and conference calls. Oh, we're using AI to make a better cup of coffee, or to make our bacon double cheeseburger taste better. But no. So everything, a lot of things that aren't AI are in bear markets. They peaked back in 2021, 2022, like Wendy's and many other restaurant stocks and other sectors. And so that's it. You just have to recognize for what it is. This is in a bear market. And what do you do in a bear trend? You short rallies back to resistance. I'm just highlighting it now, but I might have covered this recently. I don't know when I had these lines here. This was created on 10/30, October 30th. And that was right there. So I guess I did cover that in the last video. I probably did highlight that the stock had rallied back into resistance and had negative divergence and provided an objective short entry. And if you did, you already made 15% in just a matter of a few weeks there. Cheesecake Factory, not my favorite. I don't have a strong opinion on it. I wouldn't trade that one. ARCO, Arcos Dorados Holdings, positive divergence. It's coming off a big divergent high. And it's broken that primary uptrend line. So the positive divergence could play out for a counter trend bounce, but this looks like a top right there. That was a divergent high, most likely a top. I'm trying to spell with a line tool. That doesn't work. I need a freehand tool. But that's it. So any kickback. There's a downtrend line. And look at the 200-day moving averages. So there's a case where, just because it has positive divergence doesn't mean I'm going long. They bought the 200s, they bought the 200s, they bought the 200s. Oops, 200s gave way. What do? Short the 200s, short the 200s. So there it is, guys. This one peaked here. It's in a downtrend. It's below its 200s. Any rallies back into the 200-day moving averages provide an objective short entry with a stop if it makes a solid recovery. Solid recovery, it's quite often you punch through for a day, maybe a couple days. So that's up to you exactly how you put your stops. I wouldn't have a hard stop on an intraday break above. Again, if you're swing or trend trading, this is trend trading right here, guys. Trend trading is you recognize a trend and then you trade appropriately. In this case, we were above the 200. Maybe you bought all the pullbacks to the 200s here and you kept buying pullbacks and to support. And then finally recognize the trend is over or has reversed, and you start shorting the stock when it rallies back. Pizza, Papa John's. This one peaked back here. That's probably, is that when he made those racist comments on his conference call? I can't remember if that was back in 2021 or whatever, but there's a stock that's long since peaked. It's fallen 70%. That's what happens when you get canceled. But I don't know if that was, I know that they did. He lost contracts, I think, with that, what was it, NFL or something? The company did. Either way, but guys, this is technicals. That's, who cares? Technicals say you're in a bear market, right? What do you do in a bear market? Well, you short rallies back into the 200-day moving averages. And if you see recovery and then it fails, and that's your cue, it failed. And so you can see this one has a history of punching a little bit above there. And what I'll do sometimes, I'll play around with the numbers, click on the moving average, and then like this, I'll go and change the value to see which fits better. I'm holding the button down. You can see, okay, so this one tends to stop on about the 356-day moving average, for example. That's you want to analyze every stock on its own merits, how it trades. Some stocks behave perfectly off the 200-day moving averages, and others have a history of going a little through there. So then you want to retrofit for each stock, or you can just visually see that, and you can even calculate the percentage it goes above there. But either way, this is it. In a bull market buy, this was a bear market, obviously COVID, but then they bought pullbacks. They bought the pullbacks to the 200s, and it would have just kept you've just been printing money, shorting this stock, covering on, with divergent lows, so support, overbought, oversold conditions, whatever else, and then re-entering or re-shorting there, and including most recently right there. And unless this trend shows evidence of a reversal, that's what it is. It's in a downtrend. So in this case, you had a double entry there. You had a rally back into resistance at 60.54. Again, I may have covered that recently. I'm not sure. But you had also a test again of the 200s, which got rejected. And then you went on to break this uptrend line here. Now you're at support. This one, you don't short it here. Plus, it's already beat down pretty good, down 70% off its highs. How much milk or meat is left on the bone? But a break below 46.66 should take it down to new lows, most likely. This one, what is that? CNNE. I'm not familiar with this company. Got nice support right here. It's just in this trading range. I don't have much of an opinion on that one. I'm going to move on. A few more guys, and we're going to wrap up here. We're almost done. KRUS, Kuro Sushi. There it is. Divergent high, drop. Divergent low, rally. Divergent high, drop. Divergent high, drop. Divergent low, rally. Divergent high, drop. Divergent low, rally. Okay, divergent high. And you remember, it's not just the divergence. This one, breakdown, back test. And there you go. And then break of 81.91. I'll open the door to the next leg down, and so forth and so on. BLMN, that's Bloomin' Brands, like Bloomin' Onion from Outback. They went Outback, Carrabba's, Bonefish Grill. Divergent high there. There's your sell signal, trendline break, double-digit drop down into that divergent low, rally, double-digit rally into that divergent high, followed by a sell signal. Well, you had an initial sell signal you can see on the minor trendline break right here. Then you went and back tested the trend line. So if you missed that, you had another objective short entry there, and then an even more significant and powerful trend line right there, broken, and then ended with a divergent low right there, rallied up after that divergent low, and then put in another divergent high right here, followed by a sell signal breakdown. And this is the stock since then. It's been riding down this downtrend line. So you can short rallies back to the downtrend line there. It's got big divergence, divergent low, and that's a lot of goodwill in these names here. Outback, Carrabba's, Bonefish Grill. Between them all, that's the only one we eat at, really. We have all three within a 2-mile radius here where I live. But either way, not one of my favorite to short, again, because it's a lot of meat's been sheared off that bone. This thing's down 60% so far this year, and coming up with a positive divergence. So, rally back in there. That is resistance. You can even take it as a long if you like. It's one of the better looking coming off that divergent low, but you got resistance there, 1528, and then that downtrend line it keeps failing at. But if it can pop that, 1810 is your next stop. And the 200s are way up here. So this one may want to come back and test the 200. So it's another example of one that I would not short right now. If anything, I'd go long this one, short the other ones that I've been highlighting. And again, on those, wait for the sell signals for those that haven't already triggered or are not currently offering an objective short entry. FWRG, first watch. Yeah, we also have those here. Breakfast and lunch only. Divergent low, but it already rallied. See that? Here's a case of stock peaked here, big divergent high, then went on to break its primary uptrend line, major sell signal, put in a divergent low, rallied, and then rejected off the back test of the trend line. Really no trade to be made now because that's all already happened. It's at support, so I don't have much of an opinion. CBRL, this one, I can tell you a nice clean downtrend line, and you got it. It's 200-day moving averages. Boom, boom. Oh, well, no. Boom, right there. Rally back. Coming off that divergent low. And you can make a case to objectively short it here because you have dual resistance, triple resistance. Downtrend line, the 200-day moving averages right here, intersecting simple and exponential 200-day moving averages, and price resistance as well. A little resistance there with resistance up here. So if it pops that, the trend line in the 200 days is probably going to run up to 63.85. And if it can power on through there, then it could come all the way up here. So again, coming off a divergent low, I'd be more inclined to wait for a break. Oh, look, let me just say it. Short here. It's an objective short with a tight stop, relatively tight stop above for the next leg down. Or if you're bullish, you can wait for a breakout above those levels and go long, and then target those two levels I gave you there. We should be about finished here. I was going to go down to oh yeah, Rick, that's right. We're going to go from gluttony to envy. Hit all the two of the 7 deadly sins here. HDL, I don't have an opinion. It's not enough trading. Jack in the box right here, downtrend line. It tried to pop it there, couldn't get it. Coming off that divergent low, but again, this is a sector in a bear market, clearly in a bear market since 2021. Make no mistake about it. Below the 200-day moving averages. So you might want to wait for a push up to the 200. So I'm going to move that trend line now. Why did I do that? To come in off the same high, now reaction, plus the 200s are right there. So you can keep shorting rallies back to the 200s and that downtrend line with a stop somewhat above. But again, there's a lot more meat on the bone for some of the ones earlier in the video that are coming off, recently or at or closer to a multi-year or all-time highs than some of these. Now, you can look at the fundamentals. If you think Jack in the Box, some of these restaurants are going to buckle, and I can almost give you my word within the next couple of years when the recession finally does dig its heels in, you are going to see some of these restaurants close their doors. So you could ride some of these down, to near zero, but you'd want to do a little fundamental due diligence on those to see which ones, especially those that are already down 50, 70%, like this one. BJ's restaurants, divergent high right there, just like that divergent high, and then was your breakdown there of the uptrend line, divergent low. So this one has pretty good resistance right here. So, and yeah, you can make a case to short here with a stop somewhat above that resistance level. Next target's going to be break 33. You're going to go down to 27.69 and then down to 21.25. That gives you a drop of from where we're at, about 42%. PTLO, Portillo's, breakout, back test, coming off that divergent low. That was also a divergent high recently that followed that and gave us this correction back. Below the 200s right now after a brief stint above them right here. Not one of my favorites. Okay, I had to pause the video there for a brief interruption. Yeah, this one, if anything, if you're looking for longs in the sector, you're coming off that divergent low, you just back tested the trend line. You go long with a stop somewhat below max target $16 right now. If I'm wrong and the sector gets some traction, or this one just marches to its own drumbeat, you have a max potential target up there about $24 if you want to just raise your stops and let it run. One more along the way. Hold on. Right there. Okay, 1868. Alrighty, two more to go. DIN. This one, it's interesting because I wanted to point out here, and I talk about this a lot, how divergences are not the be-all, end-all. Quite often they signal trend changes, but especially in a bull market, negative divergences sometimes don't play out at all or play out for very little counter trend move. And in a bear market, you can see this one peak back here with that beautiful bearish rising wedge, big negative divergence. The stock from there has fallen 72%. So you're talking, most of this company's market cap being wiped out. This is how low it got here in COVID. Now, here you can see you had divergence. So I put an X there because that positive divergence, and you even had a downtrend line break, but it was an intraday. It didn't even close, no daily close above there. And it got rejected and sent back down, and you never really got a rally. You did have, from that divergence, I'm talking about this positive divergence here, you did get some consolidation. So I always say that, you can look at a reaction or a counter, reaction as a consolidation in price, or a move in a move in price or a move in time. In this case, you went sideways for a few months. And then you can see, once again, you put in positive divergence here, but just no rally whatsoever. And that's why I have the two X's there. And you can also see, again, recognize the trend. We're in a bear trend. Below the 200s, what did they do? Every time it hit the 200s, boom, and then boom again. So now if this breaks the 200s, then that's going to be bullish. And that's a case where you might want to go long. Something's either going on, something different with the sector, or at least this particular company. Remember, birds of a feather tend to flock together, but they, some of these restaurants have different business models completely. I don't know this one. You can look at it. Again, I can tell you positive divergence. And it did. It broke out, had a little rally, and it's so far been stair-stepping higher. It's in a near-term uptrend. You have lower lows and higher highs, but you need to break this level right here. And if you do, I'd have to update this. I'll give you a first target right there. And that's it. Or you can keep shorting. Like I said, when you get a stock that's already down 70-something%, if you can make a good case, they have a massive amount of debt coming due. Keep that in mind too. A lot of these, it's not just the restaurant sector. Rates by most, not everybody, and myself included in that, not everybody can't, but most folks thought rates are going to be a lot lower by now. You have a lot of companies that took out very low, very cheap debt after COVID hit, and the government put rates, went to a zero interest rate policy. And so you have a lot of companies that are starting to roll over, or will be soon rolling over, a lot of debt. And they're looking at, they can't get that 4% 5-year rate anymore they were getting back then, or whatever it was. They're now looking at 8% or whatever, or a lot higher. And so that will take some of these down. So that's, you want to, if you are going to short a stock that's down 70%, you're going to keep doing that. Be careful, because you're going to get short covering rallies along the way, and what would trigger it would be a break of that. And so if that happens, and maybe a quick counter trend long trade, max target up there at about 52 would be my max. If I decide to take this one, I'm going to set an alert right now. That would be about a 38% rally. Set alert. There we go. Price 37.26, and I'm going to set an alert on the trend line as well. Okay, last one. So that's all so far. I covered the gluttony stocks, McDonald's, Starbucks with their venti latte, Taco Bell, you name it, Shake Shack. Now we'll find the final one is this is the Lust. As far as the 7 cents go, this is Rick RCI Hospitality. They own all they own are titty bars. You can go to their website and check it out. They own what they call gentlemen clubs. I'm sorry, pardon my vernacular. But and so they actually, you can see they've recently taken out the 200-day moving averages. See, they got rejected there, they got rejected there. Once they lost them here, they got rejected. And so that's worth noting. And they also took out this downtrend line. So I guess this is a business model that's working right now, coming off that big divergent low. However, it's got a pretty significant resistance zone right here, and it is in a bear market. So personally, I'm not taking this. You can make a case, as I just did, based on the breakout of the downtrend line and the 200-day moving averages. But again, pretty significant resistance here. And if it fails, then what you could do, if you see this breakout fail and we move back below the 200s and you lose this trend line, this stock will probably head lower. That's RCI Hospitality. It used to be known as Rick's Cabaret, but they changed that name probably to they were probably getting excluded as a sin stock from so many pension funds and other funds that try to exclude companies like this. All right, guys, let me wrap it up here. Long video, lots of trade ideas, and I'll try to do one or two more before I leave. I'll be here through tomorrow, and then again, gone out of town, leaving Thursday, coming back, not this coming weekend, but the following weekend. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.